We're now at the halfway point of 2026, a year shaped by geopolitical noise, higher oil prices, and renewed rates volatility. In this mid-year update, I'll share our outlook for UK and European markets, focusing on the key themes across risk, rates, and geopolitics, and what they could mean for the second half of the year. The first theme that we've been seeing is a real disconnect between markets. On the one hand, risk assets have stayed resilient. Earnings growth, credit spreads, and sentiment suggest investors are still comfortable leaning in. But on the other hand, rates markets have repriced. The narrative has shifted away from cuts are coming and towards higher for longer. For clients, that isn't all negative. We think today's higher yields can be attractive in cash and short duration assets. And with volatility having increased, the investment desk is seeing more opportunities. Also, a steeper yield curve can be supportive for bank net interest income, which is a reason we remain very constructive on financials, which continues to be a core part of our opportunity set. The second related theme is geopolitics, especially the ongoing Middle East conflict, which remains the key swing factor. Headlines are hard to predict, uncertainty is elevated, and conviction is low on near-term outcomes. But what we can be clear on is the transmission mechanism. The longer the Strait of Hormuz remains compromised, the more inflation pressures can build, and second-round effects become a bigger concern for central banks. So the longer this runs, the higher the risk is of real economic scarring. We'll see higher risk premia, delayed investment, and more cautious consumers and corporates. For the UK and Europe, energy security is central. Europe is structurally more exposed, so the macro impacts tend to be more direct through costs, confidence, and policy trade-offs. That said, the US is not immune. Spillovers can still show up via fuel prices, inflation expectations, and tighter financial conditions. And this energy shock is coinciding with the AI boom, which is adding demand for similar inputs and is often less price sensitive. The third theme is central bank pricing. Markets have increasingly embraced the view that policy will stay restrictive. And that's understandable given how cautious central banks remain on inflation. But I'd flag a risk. Pushing rate cuts well into 2027 may underprice a plausible outcome, that slowing growth forces central banks to reduce the level of restrictiveness. Now, you don't need a dramatic recession for that shift. If growth cools, credit conditions tighten, and confidence softens, central banks may choose to ease simply because holding policy unchanged becomes unnecessarily restrictive. From here, we frame the rest of 2026 in three broad paths, more as themes than point forecasts. The first scenario is one of contained geopolitics, which leads to orderly energy. In this scenario, risk assets can stay supported, and rates will mainly be driven by domestic growth and inflation factors. A second scenario is intermittent escalation, which leads to higher volatility. In this backdrop, well, it's clearly choppier. Even if risk holds up, you'll get more frequent repricing in rates, FX, and credit spreads, so liquidity and agility matter more. And another scenario is probably more of a tail risk, and that's one of material disruption, leading to a sustained energy shock. Now, this is a tougher mix of energy-led inflation pressures alongside weaker growth. This would drive a more pronounced risk-off narrative in the market. There are a few things we're watching closely in the UK and Europe. Energy prices and energy volatility, inflation expectations and not just backward-looking data, signs of growth cooling at the margins, so confidence, hiring and credit conditions, and front-end repricing and what this implies for cash and funding conditions. So to wrap up, risk markets remain buoyant, rates markets have reset higher, and geopolitics through the energy security and volatility remain the key swing factor. Europe is more exposed than the US, even though the US is clearly not immune. In this environment, higher yields can be attractive for clients, and a steeper curve can support bank fundamentals, which is why we remain very constructive on financials as a core opportunity set. And we stay humble about the path. Markets may be too confident in pricing out cuts far into the future, because slowing growth can still force central banks to reduce restrictiveness. In summary, risk has so far remained resilient, even as rates have repriced higher. Geopolitics and energy security are the key swing factors. Europe is more exposed, but the spillovers are global. Financials benefit from higher yields and steeper curves. And active risk management matters more in a wide range of outcomes. We are always focused on helping clients achieve their goals. You can read our views in our Global Liquidity Mid-Year Outlook. If you'd like to discuss what this means for your portfolio, please get in touch with us.